There we go with U.S. markets. You can see not a lot of change there. Yesterday there were big rallies, and of course over the past year, and in 2024 in particular, there has been a very substantial year. Our next guest is bullish on the 2025 outlook for U.S. stocks. Matt Orton is Chief Market Strategist at Raymond James Investment Management, and he joins us now. Matt, thanks a lot for joining us. Well, it's been not only a good year for U.S. stocks, a great year, as a matter of fact, that builds on a very strong year in 2023 as well, 20% plus gains in both years. What do you believe, what causes you to be bullish for 2025?
Hi, Paul. Always great to join you. And I think what is most optimistic as we look forward is the fact that you have a very solid economic foundation that we're going to continue to build on through the corporate sector. So when you look at the economy, recession's pretty much off the table. If anything, there's risks of a reacceleration of growth, which could put upward pressure on interest rates. But by and large, the solid economy is allowing earnings growth to continue to improve. And on top of that, you're also seeing a broadening of earnings growth, finally translating into an increased breadth across price. So you're seeing more sectors participating in the rally. You're seeing very healthy rotation across the market. And that's the lifeblood of a bull market. We're seeing a lot of different things work. And what I'm most excited about is that when you look down market cap to smaller cap companies, when you look at cyclicals like financials, some parts of the industrials complex, those are areas that I think can continue to do very well moving forward, especially as earnings growth picks up next year.
What are some more of the drivers of smaller cap stocks, mid and small cap stocks?
So, Paul, small and mid cap stocks really haven't worked for the past couple of years because their fundamentals weren't good. Earnings were not growing, and you are continuing to see ratcheting down of earnings expectations quarter after quarter. That is changing. And when you look at the last quarter of earnings growth, you finally saw an inflection across the small cap complex where earnings estimates are actually increasing. And there's actually a reason to believe that's going to continue. Financials make up a bigger portion of small cap companies. The state of regional banks and smaller cap financials is much, much better than it was last year. So you're going to get that year over year lift to EPS growth. But also because the economy is continuing to grow, this part of the market is more levered to the economy. They're also levered to lower interest rates, which are continuing to come down. And so all of that creates a very good cocktail of tailwinds for smaller cap equities. And then throw in the fact that valuations are still very, very cheap relative to large caps. I think those are all reasons why small can continue to work in 25.
Here are some stocks that you like, and we'll ask you why you do like them. You like a company called Leonardo DRS, which looks like a mid or small cap stock. It's a market cap about $9 billion US. It's a defense electronics specialist, and we see your other picks as well. We'll do our best to get to those other two, but let's begin with Leonardo. Why do you like Leonardo?
Yeah, so Paul, I've been telling a lot of our clients to play offense with defense. It's been a key theme in the second half of this year that I think extends into 2025. There's a lot of known unknowns with respect to geopolitics. We're seeing not only the US, but a number of countries around the world increase their overall defense spending and certainly not decrease it. And a company like Leonardo, which specializes in the electronic side of things, software systems, that's where a lot of money is being spent to improve global defense systems around the world. So there's a lot of tailwinds. What I like most about Leonardo is that there's visibility with respect to the contracts that they have. Margins have been improving. There's better free cash flow generation. So all of that sets up for a very high quality, smaller cap company on the defense side that I think has a lot of legs to continue to rally next year.
You also like Vertiv Holdings, ticker symbol VRT, market cap $50 billion. It operates in the power systems segment. There you see the chart on Vertiv. It has soared from about $40 US per share to the current price of about $134 US per share.
Vertiv has been a top pick of mine for this entire year, and I've been encouraging clients to use downside opportunistically, especially the pullback this past summer was a great re-entry point. And I would say the same thing going forward because there's incredible tailwinds to their business. The business is levered towards data center growth and artificial intelligence and power management across data centers. So as we run into issues with power capacity, as we need to cool down a lot of the large data centers as compute continues to increase, Vertiv is one of the top beneficiaries for a lot of those trends. And again, what I like about Vertiv is the fact that there's strong visibility with respect to the backlog that they have in contracts. So I know that there's going to be good free cash flow going forward. And I also know that management continues to, I'll say, under-promise and over-deliver, even when expectations continue to go up. So it's a really, really well-run company. The gains might be eye-popping so far this year, but that's the space that I think continues to move higher. The electric equipment part of industrials is one of my favorite industry groups within the US, and Vertiv is, I think, a best-in-class name to get leverage to that.
Okay, we're short on time. Very quickly, in less than 60 seconds, tell us why your way to play the financial services sector is this ETF, the Spiders S&P Capital Markets ETF, ticker symbol KCE.
So Paul, one of the key things I've been telling clients is that financials are going to continue to outperform. You've got deregulatory tailwinds. You also have increased M&A that's likely to take place. Having exposure to capital markets company gets you exposure to both of those themes. And what I like most about this ETF is that it's equally weighted to some of the best-in-class small, mid, a couple of large capital market companies that have exposure in particular to M&A activity and better financial deregulation. So that's a name to continue to, I think, lean into, again, particularly on weakness, if we get any heading into next year.
Matt, thanks a great deal for stopping by to talk to us today. Matt Orton is Chief